Welcome back, traders. So let's get started. POI refers to a specific area where traders take risk to enter a long or short position based on their analysis, and they believe that this zone provides the highest possible probability for them if they enter into the market. Some smart money traders believe that when the market breaks a structure and forms an order block, there is a perceived high probability that the price will respect that order block, and they consider order blocks as POI areas. Consequently, these traders place their buy or sell orders at the order blocks, anticipating that the price will activate their orders and initiate a reversal from those specific areas. However, it is important to note that the market often fails to respect order blocks, leading to losses for many traders. There are various reasons why order blocks may not behave as expected, resulting in unfavorable outcomes for those relying solely on this strategy. However, in the realm of true smart money concepts, it is crucial to understand that we cannot utilize every order block as a point of interest or POI to enter the market. While order blocks and POIs may coincide in certain situations, it is important to recognize that there is a distinction between them. Not every order block can be considered a reliable POI for initiating trades. It requires a deeper understanding of market dynamics and context to identify the most suitable POIs for entering the market effectively. It's crucial to understand that if the price sweeps a liquidity zone before reaching our identified order blocks, then we can consider that order block as a zone with a higher probability of success. The underlying theory is that the market relies on liquidity to sustain its movement. If the price fails to sweep liquidity before reaching an order block, there is a greater chance that the price will utilize that zone as a source of liquidity to propel its momentum. It's essential to consider this aspect when identifying potential entry points in the market, as it can significantly impact our trading decisions and outcomes. What is the precise definition of POI, point of interest? Traders, it's important to understand that POI is not the same as an order block. It refers to a specific zone in the market that has taken out liquidity. It is typically created by a single candle that sweeps the liquidity accumulated above or below the previous market structure. Now, let's explore how we can identify high-probability POIs in the market. In the bearish scenario, the bearish point of interest zone is formed by the last buying candle that sweeps out the liquidity above the previous high. This occurs right before a sudden and significant downward movement in the market. We look for a liquidity sweep characterized by a long wick or body, followed by an immediate and sharp downward price movement. For a high-probability, bearish point of interest, it is crucial that the price sweeps the liquidity above the highest point of the previous structure using only one candle body or wick. Additionally, the subsequent candle's body or wick should not exceed or close higher than the first candle's body or wick. We want to see an immediate reversal in price direction, with the price returning to the range below the high after the liquidity sweep. In the bullish scenario, bullish POI is the zone that refers to the last selling candle that sweeps the liquidity below the previous low, occurring just before a significant upward movement. We look for a liquidity sweep characterized by a long wick or body, followed by an immediate push in price to the upside, with the price returning to the range above the low after the liquidity sweep. A bullish POI pattern is considered valid when the price action sweeps the liquidity below the previous low using a single candle's body or wick. It is important that a second candle's body or wick does not form or close lower than the first candle's body or wick. This indicates a strong upward momentum and reinforces the bullish potential of the pattern. Before we proceed to analyze real price chart and see real POI examples, let's take a moment to understand the theory behind POI. This will help us establish a solid understanding of how price movement occurs in the market. To illustrate this concept, let's suppose we have structures like this that simulate price movement. If we take a look at this structure, we can see that price initially experienced an upward movement and broke the previous structures to the upside. Following the rally, it retraced downward and swept the liquidity below the previous low. However, it quickly reversed its direction and moved back up, leaving behind a significant inefficiency. Furthermore, it formed an internal high, followed by a minor pullback, accompanied by a strong upward move that led to a break of the structure. After the break of structure, many traders find themselves in a state of confusion. This is because during a bullish upward rally, there are often multiple demand zones and order blocks that have the potential to cause price reversals. In some cases, we can even identify 3, 4, or more order blocks within such a rally movement. Typically, we can easily spot at least 2 demand zones or order blocks in these situations. When a zone like this one near the break of the structure appears, traders often begin to believe that the market has already created a break of structure. They anticipate that the price will continue to push to the upside, and they start looking for a buying opportunity from this order block. For us, this order block represents an inducement level. Price intentionally tried to create a structure that would mislead traders into thinking that the price was about to reverse to the downside. This induced traders to enter the market by opening sell positions and setting their stop losses above the internal high. However, contrary to expectations, price quickly moved upwards, breaking the recent structure. This created a false demand zone and order block. It seems that the price was intentionally manipulated to mislead traders and generate additional liquidity for large smart money players, such as central banks and major financial institutions. So how can we avoid falling into market traps like this? To avoid falling into market traps, it's important to adopt effective strategies. In the given example, we can see that the price has reached an inducement zone. However, there is no liquidity sweep on the left side of the zone. As we discussed earlier, for an order block or POI to have a high probability, the price should have taken out the liquidity accumulated in the market before reaching these zones. This means we need to focus on zones where there has been a prior liquidity sweep, as it increases the likelihood of identifying high probability order blocks or POIs. In the subsequent, we can see price moving downwards and reaching the inducement zone. Additionally, a small pullback to the upside is formed, which is attributed to the buying pressure of traders who entered the market with long positions from this zone. This minor pullback further induces more price action traders to enter the market by going long and placing their stop losses below the inducement zone. This collective activity creates a well-defined liquidity zone positioned just below the inducement zone, awaiting the market to sweep it. Traders who have placed their stop losses within this liquidity zone are providing a potential fuel source for the market's momentum. At the extreme point, we can see that price moved lower, sweeping the liquidity below this low. Subsequently, the price reversed to the upside and eventually broke out of this structure. In this scenario, the zone containing the last selling candle becomes our high probability POI, indicating a strong potential for a price reversal. Why do we consider this zone as a high probability area? We consider this zone as a high probability area because the liquidity below the recent low has already been swept. This means that many stop losses have been triggered, leading to a sharp increase in buying pressure. Additionally, the price has started to move upward with significant momentum, indicating a strong bullish bias. Traders have limited opportunities to enter the market and adjust their stop losses. Furthermore, it's important to note that there is no significant liquidity pool below this zone due to the aforementioned scenarios. Now, as you can see, the price successfully swept the liquidity behind the inducement zone and pushed back down to our extreme POI zone. Our next step is to monitor the price as it enters the high probability POI. Once the price action is pulled into the higher time frame point of interest, we shift our focus to the lower time frame. Within the higher time frame POI zone, we search for a change of character in the lower time frame. Additionally, we identify a new order block in this case, a demand zone on the lower time frame, which is created by Chalk's wave. When these conditions align, we consider a long opportunity, with our target set at the external liquidity, which serves as the take-profit level. Once again, we see that the price has broken this structure in an upward direction, resulting in the creation of a bullish order block. This breakout left a great inefficiency in the market before the price retraced downwards. However, after this zone was effectively mitigated, price reversed its direction and moved back up. The key factor behind this reversal is the existence of a high probability point of interest in this area. This POI was formed as the price strategically swept the liquidity below the previous low before initiating the upward push. If we shift our attention to a lower section of the chart, we come across an order block located at the extreme. However, it becomes evident that this zone does not offer a high probability setup, despite its positioning at the extreme. The reason behind this is that the price did not effectively sweep the liquidity below the recent swing low. Had the price successfully swept the liquidity below this low, then this zone would have served as a high probability point of interest. Comparatively, it holds greater significance due to its extreme placement in comparison to the upper POI. Now in this case, our next course of action is to closely monitor the price movement as it enters the high probability point of interest in the higher time frame. Once the price action reaches this level, we should zoom into a lower time frame and patiently await the formation of a valid change of character pattern. It is crucial to identify a lower time frame order block generated by Chalk's wave during this process. Once these conditions align, we can consider initiating a long position, with our target set at the external liquidity level. In this particular case, our target aligns with this swing high. Furthermore, if the price fails to exhibit any change of character or bullish reaction on the lower time frame, our attention shifts to the order block situated at the extreme. This order block becomes our high probability point of interest for a buying opportunity. The rationale behind this is that the price has already utilized the upper POI as an inducement area, successfully sweeping the substantial liquidity accumulated below that zone. This liquidity is primarily generated by the stop-loss orders of traders who entered the market aggressively with long positions. Our next step is to patiently wait for the price to reach the extreme order block. Once it reaches this level, we can consider entering a long position after the creation of a valid change of character pattern on the lower time frame. Now, let's explore another type of point of interest, POI zone, in the market. In this scenario, we don't necessarily have to wait for the price to reach the extreme order block. Instead, if the price creates a valid bearish or bullish POI pattern, we can consider entering the market after identifying a change of character or a shift in market structure on the lower time frame. As mentioned earlier, a valid POI occurs when the price sweeps the liquidity below or above the recent low or high with a single candle. It's important that a second candle or wick does not form or close above or below the body or wick of the first candle. Following the liquidity sweep, we expect the price to immediately reverse and re-enter the range of the recent high or low. This sequence confirms the validity of the POI pattern. Here, we can see that the price breaks the structure to the upside. However, it is important to note that price tends to take out the liquidity below the inducement zone as it fuels its momentum. By doing so, the price creates a stronger base and clears out any pending orders or stop losses below that level. As we can see, price initially moved downwards, sweeping the liquidity below the lowest point of the inducement zone. However, it quickly reversed and closed above the low with a single candle, indicating a valid bullish point of interest, POI. This presents an opportunity to enter a long position after confirming the entry with a change of character pattern on a lower time frame. Notably, in this scenario, there's no need to wait for the price to reach the extreme order block before entering the market. Many traders make the mistake of waiting for the price to reach this extreme order block, expecting it to mitigate the extreme demand. However, in this setup, the price ignores the lower order block and instead creates a bullish POI. It shows a change of character on the lower time frame and sharply moves back to the upside. Traders who wait for the price to come back down and mitigate the extreme demand often miss the trade opportunity. It's important to understand that in this setup, there's no need to wait for the price to mitigate any kind of order block. Same scenario applies here. As you can see, price after creation of a BOS pushed back down. Once the inducement zone is mitigated, a small pullback to the upside occurs. This pullback is driven by the buying pressure of traders who entered the market with long positions from this zone. The minor pullback attracts more price action traders to enter the market by going long and placing their stop losses below the inducement zone. As we continue, we can see that eventually price dropped and effectively swept the liquidity behind the inducement zone. It then made a downward push and after mitigating the extreme order block, exhibited a slight reaction to the upside. However, the price sharply moved lower to clear out all the stop losses that were placed below this low and recent order block with a single candle. Following this, the price immediately reversed and created a valid bullish POI. With the emergence of a valid bullish POI pattern, our focus now shifts to the lower time frame, where we search for a valid market structure shift. Once we identify a valid change of character pattern, it signals a potential long opportunity. Our target is set at the external liquidity level, which serves as our take profit level. Now that we have covered the various types of POIs in the market and gained a general understanding of how to identify high probability zones, it's time to apply this knowledge to real price charts. By examining actual price data, we can see firsthand how these POIs are identified and how they function in real trading scenarios. Before diving into the real chart, it's important to note a crucial step in your trading journey: backtesting your strategies. Before applying any strategy to your real account, it's recommended that you backtest it at least 100 times. This is because a strategy's win rate is dependent on various factors, such as market conditions, trader psychology, trading sessions, risk management, and time frame. Here, we're looking at the 15-minute time frame of the pound-dollar currency pair. As you can see, the price was in a significant downtrend, consistently forming lower lows as it moved lower. However, there came a point where the downside momentum faded, and the price broke above the most recent high, signaling a shift in market sentiment and a notable change of character. Now that the bullish change of character pattern has emerged, our focus shifts to identifying the demand zones that offer a high probability for entering long positions. These zones act as areas of strong buying interest and provide potential opportunities for favorable risk-to-reward trades. Here we can identify a bullish order block near the break of structure. Moving a bit lower, we can identify another bullish order block. Additionally, at the extreme, we can see that price swiftly cleared the liquidity below the recent low in a single candle, closed above the range, and then promptly pushed back up. So, we have identified a valid bullish point of interest that corresponds to a perfect demand zone on the extreme. This indicates a high probability area for potential trades on the bottom. Considering the three zones we have identified, which one do you believe would provide a higher probability for a successful trade? Before answering this question, it's important to highlight a key point. We consider liquidity sweeps as a significant factor of confluence before entering a buy or sell position. The concept behind this is that the market requires liquidity to sustain its movement. If the price fails to sweep liquidity before reaching a demand or supply zone, there's a high probability that the price will utilize that zone as liquidity to fuel its momentum. As you can see, there are no liquidity pools formed above these two zones. Therefore, I do not consider these decisional order blocks as points of interest because the price did not sweep any liquidity before reaching them. Instead, I view these zones as inducement areas that create liquidity pools below themselves. These liquidity pools are formed by the stop losses of traders who entered long positions as the price reached these zones. However, if we look at the lower price levels, we can see that the price has successfully swept the liquidity below those previous lows and formed a valid bullish POI. Therefore, this area becomes our high probability demand zone. On the other hand, the upper decisional zones can be considered smart money traps because many traders tend to look for buying opportunities after a change of character pattern has been formed. These traders anticipate that the price will initially decline, after mitigation of this order block, reverse its direction to continue moving upward. In contrast, some traders who use premium and discount zones in their trading strategy are waiting for the price to reach this order block located in the discount zone and then reverse to the upside. However, in reality, as we discussed, this area on the extreme is our high probability demand zone due to the liquidity sweep. Therefore, we only consider this zone as a potential entry point for going long in the market. Now let's see what will happen. As you can see, price has entered the upper order block and also showed a slight reaction to the upside. This reaction is caused by the buying pressure from smart money traders who entered the market with long positions from this bullish order block. Now let's continue. As you can see, the price pushed lower and hit the stop losses placed below the decisional order blocks. Finally, the price is pulled into the extreme POI. As the price action is pulled into this higher time frame point of interest, we shift our focus to the lower time frame, such as the 1-minute chart, to obtain a clearer view of the price action and search for any signs of a change in character. Once we have valid entry confirmation on the lower time frame, we can enter a long position from this zone. Our target for the trade is set at the external liquidity, which in this case corresponds to this high point on the chart. Again, if the price breaks this high to the upside and creates a new bullish order block, we can anticipate new demand zones to be formed, and we can look for new buying opportunities from them. Now let's see what happens next on the chart. As you can see, the price has broken out of this structure to the upside and closed above it, indicating a new break of structure. Our next step is to identify the potential demand zones that are generated by this new break of structure. Here, we have identified a demand zone attributed to this bullish movement. However, upon closer inspection, we can see that the price failed to create a valid break of structure because it did not break and close above the recent high. As a result, traders should be cautious with this demand zone, as it may actually be an inducement zone, designed to trap traders and create liquidity below it. It is important to exercise caution and avoid falling into this potential trap. If we look back a little, we can identify this most recent low, which was subsequently swept by the price's next move in a single candle. The price then closed below the lows range, but immediately pushed back up. Notably, the second candle's body or wick did not close lower than the first candle's body or wick, indicating a valid bullish point of interest, POI. Therefore, I'm going to highlight the last selling candle that swept the liquidity below the low. This zone becomes our point of interest, and if the price pulls back into this zone, we will be looking to enter the market by going long. Now let's continue. It's important to remember that price does not necessarily need to mitigate or touch all demand zones, such as POIs or order blocks, in order to continue its movement. The primary focus for price is to gather momentum by sweeping liquidity, which provides the necessary fuel for its movement. So, the key factor that determines price behavior is the presence of liquidity in the market. So, in this case, we see a similar scenario where price takes advantage of the sell-side liquidity in the market, and after grabbing sell-side liquidity, it pushes higher, using this zone as an inducement, and triggers the stop losses of traders who had entered long positions from this zone. Afterward, price moves lower and lower, sweeping the liquidity below the previous low with a wick. Following this liquidity sweep, price quickly reverses and pushes higher, closing above the previous low. Therefore, this most recent POI zone holds higher priority for us compared to the previous unmitigated POI that was formed earlier. With the appearance of a valid bullish POI pattern, we can now shift our focus to a lower time frame, such as the 1-minute chart, to identify a valid market structure shift. Once we spot a change of character that meets our criteria, we can consider it as a long opportunity with our target set at the most recent high. Now, if the price closes above this high and creates a new break of structure, we can start identifying the next potential point of interest. Let's check out the price action to see what unfolds next and if a new BOS is formed. As you can see, price has taken out the liquidity above the high, but closed below it. Therefore, we cannot consider this as a valid break of structure. In order to confirm a break of structure, the price must not only break the recent structure, but also close above or below it. This ensures a more reliable signal for potential trading opportunities. In this case, we can consider the price action as a liquidity sweep pattern, where the price swept liquidity above the recent high with a single candle and closed below the high's range. This creates a reversal bearish POI. To further analyze the trade setup, we can switch to the 1-minute time frame and look for a valid change of character pattern. Once identified, we can consider taking a short position with the recent POI zone as the target for taking profit. It's important to note that this trade setup goes against the dominant trend of the market, as the market is in an uptrend. Since the price couldn't make a valid break of structure, we can consider it as a short-term selling opportunity. However, I want to emphasize that this type of risky entry method requires extensive experience and hours of backtesting. It is not recommended for novice traders unless they have thoroughly backtested it at least 100 times based on their trading style. Let's continue and see what unfolds next. As you can see, price pushed to the downside, and if we had entered a short position, our take profit would have been reached. Furthermore, after the mitigation of the previously identified bullish POI, the price sharply reversed to the upside with strong momentum candles. This indicates another potential buying opportunity from this zone. Now, we have witnessed another break of structure to the upside. It is noticeable that there is an order block generated by the recent upward movement, positioned just before the break of the structure. As we previously discussed, this zone should be regarded as an inducement level, and it cannot be considered a valid demand zone since there is no liquidity sweep. Without a liquidity sweep, the order block or supply and demand zone holds no significant value. As previously discussed in the POI scenarios, if the price moves lower and sweeps the liquidity behind the order block, creating a valid bullish POI, we can consider entering a long position after obtaining confirmation on a lower time frame. The entry confirmation on the lower time frame is crucial before initiating the long position. As you can see, price created a strong downward movement and efficiently swept the liquidity below the order block with a single candle. Following this, the price closed above the range of the structure, confirming the formation of a valid bullish POI pattern. To further enhance our entry decision, we will monitor the 1-minute time frame for the emergence of a valid change of character pattern. If such a pattern is identified, we can consider entering a long position, with our take profit target set at this high. If we look at the price action slightly below, we can notice that the price aggressively swept the liquidity below this low point using a red dragonfly candle. It then closed above the low, indicating a rejection of further downside movement. Afterward, the price created a strong upward push. This formation signifies a perfect bullish point of interest situated at the extreme level. Such a POI holds a high probability for a buying opportunity, and we can contemplate going long if the price confirms the POI through mitigation. Let's continue and see how the price develops from here. As you can see, price showed a strong upward movement from the upper POI, sweeping the liquidity above the recent structure with a long wick. However, it failed to close above the structure and form a break of structure. Instead, a bearish reversal POI has been formed, indicating a potential opportunity to enter a short position from this candle for a quick profit. Our take profit target can be set at this recent internal low. Since the price was unable to make a new break of structure to the upside and has already swept the buy-side liquidity, it is likely that the price will move downwards to sweep the sell-side liquidity before continuing its primary bullish trend. As you can see, price drastically pushed to the downside and hit the take profit levels of traders who had entered by short from the reversal POI. Then price pulled into the extreme bullish POI. As the price action entered into this 15-minute point of interest, now we shift our attention to a lower time frame, such as the 1-minute chart, to gain a clearer understanding of the price action and identify any indications of a change in character. Once we have confirmed a valid entry signal on the 1-minute time frame, we can consider entering a long position from this zone. Our target for this trade would be the external liquidity level, which in this case refers to this high. Now let's see what happens next. As you can see, after price mitigated our point of interest or POI zone, it made a strong upward move and successfully reached our take profit level, highlighting a very successful outcome. Remember that trading is not just about making profits, but also about managing risks and being disciplined. It takes time and practice to become a successful trader, so don't get discouraged by losses, and always keep learning and improving your skills. Keep up the good work, and I wish you all the best in your trading journey. Thank you for watching this video. I hope you found it informative and useful. Don't forget to hit the subscribe button and turn on notifications to stay updated on our latest videos. We value your feedback and suggestions, so please leave your comments below and let us know what topics you'd like us to cover in our future videos. We appreciate your support and look forward to seeing you in the next episode.